Hello everyone, Scott Meyers here again. I'm talking to you today about the anatomy of a private money deal. No banks, no problems. So we've had a lot of questions about folks that are looking at our deals that we're using, bringing in private investors, and they want to know, okay Scott, what is the best ratio? What is the most amount of money that I can give my investors without leaving too much on the table for myself? And the answer is it always depends. It depends upon the deal and how much it cash flows. Is it a development deal? Is it a distressed turnaround? Is it just kind of humming right along? You know, what's the exit strategy and what's the potential on the back end for the investors and for yourself? So once you kind of pencil it out and work through the numbers, then you'll know what is right for you, whether it's 50-50, 60-40, 70-30, 67-33, whatever the ratio is. It just depends upon the deal. And how much to you? Well, anywhere, I've seen anywhere from the promoter, meaning myself, if I'm putting a deal together, putting no money into the deal and getting 50% of the equity, to getting putting 50% of the cash, my own cash in, and getting 50% of the deal. We'll talk a little bit more about that in a moment. The fee as a promoter, kind of typical is an acquisition fee of around 3%. In other words, if I'm putting the deal together, I'm not a broker, but I'm putting the deal together, and so I'm going to get an acquisition fee for putting it all together of 3%. And that includes, you can put 2% for acquisition and 1% for doing the due diligence or just lumping it all in as 3%. That's typically what we do. Returns anywhere, preferred, we want to give preferred returns to our investors first to entice them to say, okay, listen, Scott, if you're not putting any money into the deal and you're getting 50%, I at least want to know that I'm getting some of my returns back first. And so you can structure that so that they give a preferred return on the income stream as well as on the exit strategy on the sale, that they get their money back and made whole first and any profits first. And I definitely recommend that, otherwise you aren't going to have a whole lot of folks interested in investing with you. Management fees, my company does also, as the promoter, my company will manage this facility, and we will charge a 6 to 10% management fee. Now that's for oversight. We'll have somebody obviously on site, somebody that we hire that's part of our staff that will manage the project, but the oversight itself, we'll get a 6 to 10% management fee on top. So if you look, you know, all of this figures into your return and what you're going to give back to the investor. But if you're getting a fee up front, especially if you're not putting any cash into the deal at all, any skin in the game, or a small amount, and still getting a decent return and a management fee, plus, again, working towards that big kicker on the back end after you create the value, that's what makes it an attractive deal. 5 to 7 years is typically when like the time that we're holding on to these deals with an exit after that, but anything's negotiable. And so if all the owners and investors consent to selling prior to that, if we've reached our maximum potential and our value, then it's time to sell. Keep an eye on the market, keep an eye on interest rates, and we'll always leave that open to what the market is going to bear. Forms you need: private placement memorandum that explains the deal and the structure to send out to your investors, an accredited investor questionnaire. Let me back up a second. We probably want to have a non-disclosure agreement first before we have them sign that before we send the private placement memorandum out. Then an accredited investor questionnaire to determine whether they're an accredited investor before we head into forming the LLC, wanting to know exactly who we're working with. The subscription agreement that also outlines what they will get in return for their shares. In other words, for the money that they're going to put in, the shares that they're going to receive in the LLC, and then what that entitles them to, the percentage of the deal. Then you'll set up the entity once we have the investors identified to purchase and hold the facility, and then an operating agreement after that that states, hey, here's what the promoter or the manager has the ability to do and his responsibilities and roles, and then the investors, here are their responsibilities and roles. And typically we have that set up where, you know, we have the right to manage the facility, and we have 100% leeway in negotiating leases, renting the facilities up and making the maintenance and repairs, and that we don't need input, and we don't want the input from the investors as well. We also establish the management agreement that everybody signs and agrees to, and then the escrow agreement for sending the money into the title company ahead of time. Okay, common questions that we get from investors that are looking to invest with us. Where's your skin in the game, Scott? Well, in many of these deals, we don't put money into the deal. And that sounds maybe a little bit hard for some people to swallow, and even for some of those investors that this is their first time around, it's somewhat typical. It's somewhat typical. You know what? If I'm going to do the legwork, if I'm putting the deal together, and I'm spending time on this, away from my other business interests, to wait to get a deferred return down the road, you know, that's my skin in the game, is working onto this deal. And I'm not talking about the 6 to 10% management fee. That's nothing for the time that we're going to spend working these deals to create the value into it. And so if you look at the returns on the back end, you know, we don't need to be so concerned that you as an investor, you as a real estate investor yourself, or the promoter of the deal, doesn't have a whole lot of skin in the game or no skin in the game, because we need to look at the returns on the back end. Besides, what do you have to lose on this deal if you don't have money in it? Everything. I have everything to lose. If the deal goes south, guess what? I'm out all that money, and I have just lost my ability because my reputation is tarnished or destroyed, and I won't have the ability to go out and raise private money and do this business that I love so much if I decide to take the money and run or just not do what I say I'm going to do. So I have everything at stake in this deal. What about capital calls, Scott? I've heard of deals where investors have put their money in, given their last $100,000 that they had in their 401k, and then the promoter had a capital call right after that, knowing that they couldn't make the capital call, and then all the ownership reverted back to him. Well, if you're looking at your operating agreements, typically they're not drafted that way. That may have been a rare occurrence that happened, but we also write up in our LLCs in the operating agreement, there's no capital calls. We'll raise enough money in the beginning to cover capital expenses, and the deal should support itself. Otherwise, if you have a provision in there that you're going to ask for capital calls, you're not going to have too many folks that are interested. Or capital calls have to be approved unanimously by all investors before any money needs to be asked for any projects or any additional improvements to the property. Scott, what happens if you die, or worse, if you're incapacitated? Okay, if I die, get hit by the proverbial bus, we have an insurance policy, a main man insurance policy. In other words, I'm the primary person driving this business, and so it's called a key person, the key management personnel, key manager, whatever you want to call it, insurance policy, up to $500,000. So if I die, $500,000 goes into the LLC, and then the remaining members will replace me. Well, what happens, they say worse off if I don't die and I'm incapacitated. Same thing, they have the ability to vote me out essentially and find a replacement. What if we don't like you, or what's happening, Scott? Scott, what happens if you steal from us? If you commit fraud? If you just grossly mismanage this property and it goes sideways or south altogether? Valid question, I suppose. However, you do have majority rights, as written up into the LLC, that you can get me out. So you should write that up in your operating agreement as well, so that if somebody's feeling uncomfortable, that what happens if you don't do what you say you're going to do they have an ability to replace you and get you out, and that provision should be put into the LLC. And what's the exit strategy? So this can be, it needs to be defined, but it can be loosely defined. In other words, here's what we plan to do, which means a unanimous decision to sell, and it could be a 3-year hold, 4 or 5-year hold. Make sure that it's unanimous by everybody involved, but also that you're open to a vote, and touch base with your investors. You should be meeting with them monthly, if not more than that, to let them know what's going on. And once you reach that peak of the value, you've turned this thing around, you know what? If you see that on the horizon interest rates may be coming, or something may be creeping into the marketplace that may erode some of that value, sell it. Sell it. And let everybody know that, hey, I think this is the time that we should be getting out. All right, so where do we start? How do we begin to put the rest of this together and actually find a deal to begin with? Well, if you haven't taken that step yet, then head on over to selfstorageinvesting.com and begin getting yourself a formal education in self-storage, so that pull down the videos that we have, pull down the other forums. We have lots of free information out there to let you know why self-storage is the asset class that private investors are looking at, and that you should be too if you haven't by now. Because of all the asset classes, this is the easiest one to get private money on, because it cash flows more than any other. It has the lowest loan default rate. And if you haven't looked into self-storage and all the articles on our website and other places, you'll find that this is the hottest asset class. This is the most profitable real estate play in the country right now. So if you want to attract a bunch of private lenders, this is the asset class, this is the sandbox that you should be operating in. So with that, head on over to selfstorageinvesting.com, and we'll see you on our next video.